Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the stochastic oscillator and how you can use it to enhance your trading strategy. This oscillator or indicator is often overlooked, but it is a very vital indicator to use in the market because it provides a valuable insight into the market momentum and potential reversal. So stay tuned as we break down the ultimate stochastic oscillator strategy, explaining its core mechanics and show you a step-by-step strategy for applying or implementing this to your trade. So stay with us. We start by understanding what the stochastic oscillator is all about. This is a momentum indicator designed to measure the position of a security closing price relative to its higher low range over a specific period. It consists of two lines, and if we check the settings of this stochastic indicator, we can see it consists of two lines, the percentage K and the percentage D. The percentage D is the percentage K, which represents a current closing price position within a range. The percentage K means the current closing price position within the range, while the percentage D means a smoothing 3 period moving average of the percentage K. This is typically what it means. This line oscillates between 0 to 100, providing insights into whether an asset is overbought or oversold. When the stochastic oscillator reads above 80, when it's above 80, it is suggesting that the price is near the top of the recent range, potentially signaling an overbought condition. Conversely, when the price is reading below 20, this means that the price is near the bottom of the range, hinting an oversold condition. This makes it especially useful for identifying potential market reversals before they occur. Now, the formula for the percentage K is straightforward. The percentage K is equal to the current close minus the current low divided by the highest volume minus the lowest volume. That is the formula for the percentage K. Now let's see what the formula is all about, and as we can see from my screen, this is the formula for the percentage K, which states that the current close minus the lowest low divided by the highest high minus the lowest low, all multiplied by 100. The percentage D line is calculated as a 3 period simple moving average of the K line. You can bear this in mind. We have to together, this line helps traders assess momentum shifts and potential turning points in the market. As you can see in this area, we can see the interaction between the K line and the D line. This interaction tells exactly what is going on the price chart. On the price market, these lines typically explain how we can enter and exit the price. One key feature of this indicator is its divergence. For instance, if price makes a new higher high but the stochastic indicator makes a lower low, this signifies a potential reversal. Similarly, for a bullish divergence occurs when price is making a new low but the oscillator doesn't make the new low. And if we look at this area in the market, we can see price is making a higher high at this area, but what's happening at the stochastic indicator at this area in time, we can see the stochastic indicator is making a lower low, showing that this is a divergence, signaling that there should be a bearish reversal. This is exactly what divergence is all about. The stochastic oscillator's ability to track momentum changes before price shifts makes it a valuable tool for traders seeking to anticipate market movement. It works best when combined with other tools like support and resistance level or trend line for additional confirmation. Now let's see how we can implement this stochastic oscillator to our trading strategy. The ultimate stochastic oscillator trading strategy focuses on focuses on identifying high probability reversal points by combining overbought zone with oversold zones with divergence and price action. The strategy is built around the interaction between the K presented line and the D percent line. Specifically, their crossover is extreme when they crossover above 80 or crossover above below 20. At the AG region, it works best when paired with a trend filter and clear entry criteria. When it's crossed over around 80, it signals starting of a selling trend. When it crosses over below 20, it means starting of a buy trend. We start by analyzing the higher time frame. When we analyze the higher time frame, we confirm the overall trend. For example, the daily time frame, we show that price when using when using an analysis, price action analysis, we can see market is trending to the upside, making series of, at this point price broke this previous structure high, making it a higher high, and there is a higher low forming at this area. You can also use your 200 EMA for looking when price is above the 200 EMA. It can show you that we are in a bullish market. So you can also use your EMA to decide the direction of the market. So adding my EMA to the chart. Let's see how we can capitalize on this. And as we can see, we have added our 200 EMA, and as we can see, it shows that the market was currently in a downtrend before switching over to the bearish market, breaking structures and trying to take over to the upside of the market. This is how you can get your trend direction. Once you have confirmed your trend direction, you move over to the lower time frame, like your 1 hour time frame. When you move to your 1 hour time frame, you look for the stochastic signals for long trade. Now remember that at this area in the market, we are retraced back to a zone where we are expecting price to continue to the upside. At this area, if we are deciding to take an uptrend, we have to look for crosses above 20 from the oversold region. So we have to look for when there is a crossover at the 20 area on the stochastic oscillator region, and as we can see in this area, this is at 5, showing that it is below 20, showing a signal of typical and oversold region. So at this moment where we see a crossover, as we can see, the K line is crossing with the D line. This is a signal for us to enter our long position. It coincides with our long position, and if we even look at this, we can see there is a little bit of divergence going on in the chart. We can see price is making a series of a lower low, and at this area price is making an equal low. It is meant to be a higher low, but in this case you can see that price is showing that is making a lower low in this area, while the stochastic indicator is making an equal low. It's making a slightly higher low. This is what is showing. So in this area we can see there is a divergence in this area. This further confirms our coincidence that it is a bullish divergence where price makes a lower low and the stochastic fails to do so. It mustn't be a higher low, it just fails to do the same thing that price was doing. So when you combine this with price bouncing off a key level, and as we can see, price at this area, we can decide that price is bouncing off. Not that we can decide, we can see that this was a support area in the market, so it coincides with price bouncing off this support area in the market. We can also combine this with our pivot point or our Fibonacci retracement areas. So at this area in the market, this is where we would want to enter our long position after confirming our trends, after confirming our our confluences of both being trading at the 20% area and price creating a divergence with the stochastic indicator. This is an example for us to take a long position in this area. Now let's look for a short position, and if we are to take a short position, remember this is the retracement back to that area we are expecting price to go for. And as you can see in this area on the market, you can see at this area on the market that price is typically making a retracement to the downside, and price is trading around the 80 region, which is the overbought region. And as we can see, price is trading at the overbought region, and at the same time we can see a crossover. When we see a crossover at this area, it further gives us the confidence to want to take this trade to the downside, taking our entry at that area we saw the crossover, putting our stop loss just above the recent swing high. Remember, risk management is crucial for your strategy. Always place your stop loss above the swing high in case of a sell trade, and below the swing low in terms of a buy trade. We will put our stop loss below the swing low in terms of a buy trade. This further helps us to secure our trade in case of any market reversal. We have to take profit at previous resistance level in terms of a buy trade. This is a previous resistance level, or we can aim for 1:2 or 1:3, or we can also use a trailing stop to trigger subsequent stochastic reversals. We can also make use of when we see a crossover in the on the stochastic indicator. This is a signal for us to leave the trade. This crossover, when we see a crossover at this area, it signals that sellers are coming back into the market, so we can decide to take our profit whenever we see a crossover, as we can see from the chart. Now this strategy emphasizes on patience and confirmation. Avoid entering trades solely based on the stochastic signals without additional factors like divergence or support and resistance. So there should be always be a confirmation when trying to take a trend. By combining these elements, you will increase your chances of entering a trade and at an optimal point, while maximizing fake out in the market, fake out or fake signals in the market. Thank you for watching this video. Alright traders, we have come to the end of this video. Engage with us with the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.